Well, the big news in the last couple of weeks has been the collapse of the $200 billion Silicon Valley Bank. The Silicon Valley Bank story is extraordinarily interesting. Following the global financial crisis, the US regulators decided to tighten up on regulations for banks. And they decided to apply those regulations for banks with assets of more than 50 billion. But in recent years, Silicon Valley Bank and others were able to lobby the authorities to relax those regulations for all banks up to 250 billion, which meant that Silicon Valley Bank was no longer subject to those regulations. And it was not being subject to those regulations that led to its big problems. The key issue now is that the regulators, who are now guaranteeing the deposits of all banks, are refocusing on those regional banks in that $50 billion to $250 billion range. And they're extraordinarily important for the US economy. They represent 60% of residential mortgages, 45% of consumer loans, and 50% of commercial loans. So you can imagine the situation where depositors, although guaranteed by the US authorities, will be getting quite nervous about the availability of their money, might be thinking about moving that money to other banks. And the regulator, of course, will be tightening up regulations in those banks to really catch up to where the regulations were before. Rating agencies will also be focusing on those banks with potential downgrades. So all of that will lead, I believe, to a significant tightening of credit availability in the US economy. And once we see that, it'll be doing a lot of the work that the Federal Reserve needed to do to slow down the economy, constrain demand, and bring down inflation. So as a result of these developments, we have lowered our forecast for the federal funds rate by 50 basis points. So we now only expect 25 basis points more in rate hikes against the 75 basis points we expected before. We expect the rates to hold at these lower levels for the course of this year, but very, very large rate cuts coming in 2024 when inflation comes under control and the US economy exhibits very weak growth over the course of the rest of this year. So what does that mean for Australia? Last week, we decided to call a pause for the Reserve Bank in April. This will be the first pause since rates started to go up in May, so it's going to be quite a significant event. A few of the reasons why we've said that is that the data that we've seen in the last month or so have indicated the Australian economy is slowing more quickly than we had expected. Wages pressures appear to be easier, and some early signs on inflation suggest that inflation pressures have also eased. We also think that the Reserve Bank has been wanting to pause for some time, but has been unable to do so due to the strength of the data. So a pause in April, but I don't think that will be the end of the interest rate cycle. I think by May, new information will be available on inflation, and the Reserve Bank Board will have new information on the Reserve Bank's own forecasts. And at the May board meeting, I think they'll see the need for one final 25 basis point rate increase for a peak of 3.85%. Just as we see very weak growth in the US economy, we're expecting to see the Australian economy stagnating in the second half of this year and through into 2024. And with a stagnating economy and interest rates at 3.85%, which is well above where I see neutral at around 3, so in other words, interest rates quite contractionary. And with inflation coming down, as we believe will be the case in 2023, from 7.8% in 2022 to 4% in 2023, the conditions will be right in the first quarter of 2024 for the Reserve Bank to start cutting rates. And we expect that the rate cut cycle will last for all of 24 and well into 2025, with a total of 6 rate cuts, bringing the rates down to 2.35, 2.5%. The other news that I think is interesting is that these developments in the US are going to put the spotlight on the Australian financial system. And of course, we love to see the spotlight on our system, given how strong our banks are, how tightly regulated they have been for some time, and given the strength of their funding and deposit structures. So that would be a big positive for people's attitudes towards the Australian economy. And then when you think about people becoming quite disillusioned with the US economy and the Federal Reserve cutting rates aggressively, I think the US dollar will come under some pressure. Finally, where Australia will be benefiting from the reopening in China, from the strong positive growth story for China. So when you add those three things together, well-regulated banking system, question marks about the US economy and the US dollar, and the lift in China, Australia becomes a very attractive place for investment, and it signals to me that the Aussie dollar could indeed become a quasi-safe haven. So we still feel very confident that although the Aussie dollar is only around 67 cents, we can see it still getting to 74 cents by the end of the year. Thanks very much.